Now, over the course of the day, we often speak about what your strategy should be when you're building an equity portfolio. It's not often that we have that conversation on this program, though, but this conversation has a bit of a twist because we're talking about dividend yielding stocks. We're talking about companies with a high dividend yield. What does this mean? Where does it fit into your strategy? We'll deal with that and more. Joining me to talk about this is Prableen Bajpai, the founder of FinFix from the personal finance angle, and from the company angle is Mr. A.K. Prabhakar, the head of research at IDBI Capital Markets Services. He's a regular on several other market shows that we have. Thank you so much to the both of you for taking the time. I will start with a broad question first on the strategy involved. Prableen, I'll start with you. When you say that you are trying to employ a dividend strategy, what does it mean and what do you look for?
Good evening, Alex. Great to be here. I think as we all keep working, part of us wants that some amount of income should be generated on its own. So that's the passive income that can be generated from a corpus, which is either deployed, let's say, in a property, so we earn again rental yield, or deployed in, let's say, fixed income instruments so that we can earn some interest. And the dividends give up the same option, wherein investors can actually buy stocks which pay regular dividends. And the regularity can be on a monthly basis, quarterly, or annual basis. So a strategy wherein investors are looking to create a portfolio for themselves of primarily dividend-paying stocks is what we call dividend investing. And when we talk about dividend investing and the whole strategy, I think it is very important to look at a couple of things before investing. First is that, counterintuitive to what we all, usually think. And like you said, that there are stocks which give high dividend yields. So, Alex, I think a lot of us assume, especially, beginners, that if the share prices are going up, the company is doing very well, that is the time when your dividend yield starts to go up, which is actually not the case. The higher the share price, the dividend yield starts to fall. So two things which I think need to be understood is, number one, what is the dividend yield? Dividend yield is the amount of dividend per share that is earned by an investor divided by its market price. So I'll give you an example here. 2010-11, there was a company which had a face value of 10, and it announced a dividend of 10 then. Based on its share price, its dividend yield was 1.6%. And 10 years later, the dividend yield is 0.16%. And this company is none other than Bajaj Finance, which has grown exponentially during these 10 years. But if you look at the dividend yield, it has actually gone down. So the first thing to remember is that dividend yield is not the right criteria when choosing. And the second is to understand the difference of dividend yield from the percentage dividend. So let's say ITC, for example, has just announced a dividend of about 6.25 rupees per share. So, a person can say that it has given a percentage dividend of 625%. Now, it seems like really high. But this amount is seen not as compared to the current market price, but the face value. And the face value of ITC is rupee 1. So in comparison to rupee 1, it has given rupees 6.25 as a dividend. So it becomes a dividend percentage of 625%. So I think knowing these two differences and broadly then choosing the stocks becomes very important.
Okay. Now that we've understood what you need to do at the start, Mr. Prabhakar, I'll come to you because there are traditionally globally several large companies that reach a scale and then beyond a point they don't need to deploy their capital and therefore they start paying out dividends to shareholders, right? Could you give us a sense as to what you would look for if you were looking for these companies here in India?
Yeah, good evening. Now, see, in India, we have most of the PSUs paying high dividend because the stock prices normally is stagnant. So the dividend yield is very good and they are very good profitable companies. If you check the price earning ratio, they are below 10, most of the companies. So PSU stocks pay very good dividend. There are few companies where stock prices have not rallied for few years. there also the dividend yield is very good. No, I will even Bajaj Auto has a very good yield of 8% because auto as a sector in the last 3 years has not performed. When a stock doesn't perform, but their profit increases, they pay more dividend, then the yield also increases. And traditionally, there are a few companies which have been 10% dividend yield, but the stock prices hardly move 10% or 15% in a year. REC, PFC are two cases where in a bear case scenario, you get 12% dividend yield. In a bull case scenario, at least 8 to 9% you get dividend yield.
But if you were to talk about building a basket of these securities, and after that we'll move to the tax aspect also, Prableen, and strategy we'll go to. But Mr. Prabhakar, if you were talking about building a basket of these securities, what would be the key ones to include? Because traditionally people have talked about ITC as a company that pays dividend on a regular basis. PFC, REC you mentioned. What are the stocks that you would add?
See, for me, growth is also important. Quality of the company is very important. So regularly we come with a report called quality dividend yield, where the ROE of the company, the growth of the company, everything is taken into account. So now, for example, I'll give an example where the results have come out about 2 days back, and there is a corporate action also. The name is NMDC, where the price is almost 125 rupees. They paid last year the dividend of almost 14 rupees 70 paisa, if I'm right. So that works to almost 11% dividend yield. But here, the government has said, no, I will demerge this company into two. One will be NMDC and there will be a NMDC Steel. So company has updated in their con call that NMDC Steel will be functional by September 2022. So maybe in next 6 months or 1 year, anybody who is holding NMDC will have two shares, that is NMDC and NMDC Steel. So there the corporate action will have a trigger. So a patient investor can make very good money, plus he will have a dividend yield which is at 11%. So it like this you have to select multiple stocks. For example, Philip Carbon is there. It is at 10% dividend yield. Now, today the sector is not doing good, but whenever these sectors are in limelight, the stock normally gives you 50-60% return. So you need to understand there are industries which are cyclic, but they are very consistent in their dividend. So if we can play it very well, then dividend where you get about 5-6% or above, plus you have a price appreciation. So we are almost in a scenario where most of the stocks have corrected. So the yields are very high today.
I'll circle back to you on a few more points that I want to understand on, but I want to go to Prableen first on the tax treatment of dividends, because this is something that has changed in the last couple of years, right? So where do things stand right now and how would you explain it?
Right, Alex. Could I just add something?
Yes, please. Of course.
So I feel for investors, Alex, there is an index which is called the Nifty Dividend Opportunities 50 Index. And it is a compilation of those companies which have paid regular dividends in the last 10 years. So I think that can be a good screening, sort of a document for investors to go through, that which are the companies which are part of that, because it has ITC, it has TCS, it also has the Power Grid, NTPC, the top 10 holdings. And the dividend yield, the average of that index works out to be about 3.52. And globally for S&P 500 also, the dividend yield has been between 2 and 5%. So I think just 2 points which I want to make here is, number one, that lower dividend yield does not mean that the stock is not good. It definitely means that the stock is good. So you have to sort of delve further and see. Investors have to dive in and check what exactly the company is doing. And second, that they should just be wary about the trap which a high dividend yielding stock can get them into. A stock, let's say, which paid a dividend of 10 rupees a share was trading at 100 rupees, and the dividend yield works out to be 10%. And there is a strong correction. It comes to 50 rupees now, the share price. So the dividend yield goes up. So these are times when investors must be careful so that they make an informed decision. Now coming to the taxation part. So in the Finance Act of 2020, Alex, the dividend distribution tax was abolished. And now it is the traditional system wherein the dividend received by investors is paid as per their tax slab. So let's say if I am a 20% taxpayer, so I will pay whatever dividend I received, it will be added under other sources of income, and I will pay my tax as per slab. So somebody who's in a 30%, if I am in my lesser slab, then accordingly I will pay my taxes. So now there is no other taxation. It's simple. Everybody is treated, as per whatever tax slab and earning capacity they have, the tax returns that they show. One difference here is, Alex, that let's say somebody is actually a trader and shows his or her income as a trader. That means it becomes a business income. There again, the dividend obviously gets added to his or her business income. So the tax treatment is different, and there some deductions can be claimed. The whole process of whatever effort was involved in, of course, holding those shares, the trading and receiving of that dividend. So these are two basic things which investors need to understand, and claims can be made by these investors who are filing their taxes as a trader. Otherwise, it is very simple. It is taxed as per your taxation slab now.
Fantastic. I will come back to you on strategy overall, but I want to circle back to Mr. Prabhakar also to add that point that you were just making, Prableen, which is a very fair point, right? If you talk about some of these PSU companies, Mr. Prabhakar, the fact that the ticket price of the share is low is what pushes the dividend yield high, not necessarily a great indication that the company is doing incredibly well, right? So what you said is important, where you look at ROE plus dividend yield and you come to a judgment as to which stocks to hold. But according to you, in your opinion, if an investor is looking to build a basket of stocks that pay good, consistent dividends, how many stocks should ideally form a part of this basket? And could you name a few that have, in your experience, been traditionally good performers, both in terms of ROE and in terms of dividend payout?
Yeah, there are many stocks, which fit into this criteria. So, for example, GAIL is one stock where the dividend yield is 6%. So previously I was speaking about 10% dividend yield. GAIL is at 6%, but there is a big growth in GAIL. If you see the expansion plan or the kind of results they have announced, I think EPS is almost 27 rupees. So there are stocks, where growth is coming, but the stock prices are not catching up with the growth. So previously we had a situation where Power Grid was not performing. Today we have Power Grid near an all-time high. So if we can understand, where the growth will come, over a period of time, then we have very good stock. But I think any basket which is almost 8 to 10 stock will be better, because there are few stock which are more cyclical and they might not perform for 3-4 years. You take the case of metals. Metal has a cycle. So every 4 years you see the stock performing, and then when the correction comes, metals are traditionally corrected almost 70-80%. So there the investor should know the risk of what he is doing. So whenever there is a correction of that kind of attitude, then he has to buy. That time the yield will be high. When the stock moves up, yield will be low. So that also we need to understand. I mentioned about Philip Carbon, a good company where they have a good monopoly. And I think they have a cycle. So at this point of time, it is at the lowest point of the cycle. So buying today, and whenever there is a good appreciation, you will get return plus. Till then, you will have dividend also. I mentioned NMDC, REC, PFC, but REC, PFC more than dividend. You will get 10% in a year return, and you have to trade in and trade out. So as an investor, many people don't like to trade in and trade out. So that will not fit the bill. There are companies like Bajaj Auto. Auto has not been doing well in the last 3 years. So that is why Bajaj Auto is having a yield of 7.5%. So whenever good times come back, Bajaj Auto will do very good. So you have Nippon AMC. Nippon AMC, there the dividend yield is high, and whenever market corrects, AMC companies correct more. So there also, once the bull market starts, you will have a price appreciation, plus till then you enjoy the dividend. And you have defense companies like Cochin Shipyard, you have HCL Tech in IT. So IT as a stock has corrected. So these are whatever stock I've talked till now is about 5% and above dividend yield. So you can select a basket of 8 to 10 stock and then you can work on it. And whenever you get a very good appreciation, then you have to reduce some position so that whenever there is a correction, you can add back. No, that will be a better strategy in my view.
Okay. I will circle back with a couple more questions, but Prableen, I want to come to you from the personal finance angle of this. If you're talking, and I've heard this being mentioned, okay, which is why I'm coming up with this conversation. I'm asking you this question. You have the taxation element of dividend, which is now at the slab rate. Fixed income investments, I'm talking about fixed deposits, are also at slab rate. Fixed deposits are considered at some point of time, especially at a certain age, you're talking about regular income through interest income. People make that comparison. They say that, my grandfather has passed this to me, or in fact, my grandfather himself depends on dividend income. Can you do a like-to-like comparison between dividend distributing companies and fixed deposits, or is that the wrong way to look at it?
Okay, Alex, I think here something which is very important to understand is when did you invest in the stock? So if we are just looking at the current time, and then we say that, oh, should I go and invest in a fixed income product or should I pick a dividend yielding stock? I'll give you a comparison. Let's say I want to park 1 crore rupees in a dividend paying stock, and let me just pick two names here. Let's say ITC. I picked it at 250 because it's now at 270 euros. And I get about 40,000 shares of ITC. Given the dividend that it has, it's usually yearly dividend. This time it had an interim dividend as well. The maximum that I would be getting in a year is this year I would have got about 4,60,000, which would again be taxable at whatever slab, I have. And if I was investing the same 1 crore in the RBI floating rate bonds, which is at 7.15%, I would have got a yearly payout of 7,15,000. Let's take another example where I say I pick Bajaj Finance, and for 1 CR, I just get about 1,800 shares, 16, 17, in fact, 100 shares. And with the 20 rupee dividend, I would only get 33,333 as the dividend. So, okay, these are expensive stocks. Let me take the example of Indian Railway Finance Corporation, which is just trading at a share price of about 21, 22, I think. So I would get about 4.76 lakh shares by investing that 1 crore. But Alex, it is paying out a dividend of 0.63 per share. That means my annual income is still about 3 lakhs from that. So I think in the present, okay, today you start investing and building a portfolio of dividend paying stocks and later it benefits you is another thing. Yes, that's a great source to build a source of passive income along with getting capital appreciation. But if somebody is looking to start earning from it right away, then I think we cannot make the comparison. Then fixed income products would definitely be better because they give that predictability to the investor.
Important points being raised. So therefore, I think the question to you, Mr. Prabhakar, is you mentioned a couple of stocks which you have to trade in and trade out of. I think maybe a misconception that people have when it comes to building such a portfolio is that they don't churn the portfolio very often. They hold it for a very long period of time. But what Prableen is mentioning is also very important, I think, from the perspective of building something for the long term. So would you look at growth stocks at this point to hold in your portfolio and then think at some point in the life cycle of these companies, they will eventually become dividend paying companies and therefore you hold it that way? Is that the strategy that you say would be better?
It depends on the risk profile of the client. There are many people, who are FD investors. For them, this dividend yielding stock, gives them a cushion because they have a regular payout. And when, and in a bad market scenario, it gives them better cushion. And, when the growth starts to come, then they get appreciation also. And, traditionally, if you take 30 years record, these stocks, whatever I'm mentioning, whatever I mentioned, they have been growth stock also. For example, Bajaj Auto has been a growth stock. Power Grid, even NAM India has a growth stock. So they have, given very good return. I think Nippon AMC has corrected almost 50% from the highest level. and again it might go to the highest level. Now that means again you get 50% or more returns, now maybe in a matter of 2-3 years. So you will have now appreciation plus return, but you need to select the stock in a right way. For example, I mentioned about REC PFC. It has never performed more than 10%. That is where it is very difficult for an investor to take a decision. But you take a company like Castrol India, which pays consistent high dividend, a very good MNC company. But I don't foresee a growth in this company. Here, it can be a trap. Why? Because the lubricant as an industry, they have become very efficient. So the use of lubricant has come down. And if EV vehicle tomorrow, after 5-10 years, if EV vehicle dominate, I don't think there is a need for a lubricant. So there, one should be very careful. So you need to understand the market dynamics. Where is the growth likely to come? Whether I will make money by appreciation plus dividend yield. This is something you have to take before you buy. This is something we educate the investor whenever we meet them or whenever we do a roadshow. So these are few criteria which everybody has to look. No, that is where dividend yield becomes a trap. But if you think the company is growth oriented and over a period of time they will grow, then I think you can take a calculated bet on dividend yield stocks.
Absolutely. One last very quick point. Prableen, we're out of time, but I want you to make this point quickly. With regard to mutual funds, there's also a dividend option, and this is something that, again, people choose for a regular source of income. Is that something to consider, or is it something else that you should do here?
I would really advocate against it, Alex, because given that now the dividend is taxed at slab, the advantage is gone totally. Yeah. The better option here for investors would to have better predictability and the regularity of flows would be to choose for a systematic withdrawal plan. And I'll give you a quick example. If let's say a 10 lakh amount is invested and assuming that it's a 12% sort of a growth and 6% is taken as payout, so about 60,000 a year, just giving an example. So through dividend, if that amount is received, let's say on a monthly basis, 5,000, and on the other side, a systematic withdrawal is done, then the tax percentage as per the cash flow in case of a dividend option works out to be about 5.2% overall. But in case of tax as percentage of the cash flow works out to be only 1.08% in case of the SWP. So in an SWP systematic withdrawal plan, only the appreciation part is taxed and not the principal that you actually get back because it's a combination of the two. So I would say SWP is a better option over dividend in case of mutual funds, definitely.
Fantastic. I think this has been a holistic conversation. Thank you so much, Mr. Prabhakar, as well as Prableen for joining in. And I'm sure my viewers have a lot of actionable insight that they can use.